The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Now, the author of The Path of Least Resistance and the Tech Insider, David White.
And welcome to a beautiful Friday, August the 3rd. It is a nice day. It was nice and sunny. I can say, though, that at 6:10, the humidity was 100% down here in Florida. We get about 10 great months of weather every year, and two really hot scorchers, generally July and August. And we certainly have the kind of humidity that makes Florida famous in the summer. But we'll continue to soldier on down here at the headquarters of Technical Trading and Investing, TFNN.com, as we continue to peruse the marketplaces. What we have going on right now, and that is the S&P is up about 27 points, 2.2 billion shares, so up on a light volume day. We continue to see a heavily shorted market that finds the stocks and indexes pretty much being juiced on very light volume as we go up. Normally these markets crack when shorts no longer quit shorting, but I don't know. I'd still have to lean to that side. Although we're up 27 points, I continue to think we could be down 50 or 80 points in one day with the wrong news out there. I don't try to buy weakness. August is on average the worst month of the year, and historically the worst month for the year. We'll have to see how the rest of this pans out. The reasons that the market is up seem somewhat dubious. That they started juicing the S&P futures pretty much when the European market opened up. Looks to me more like, I don't know, maybe they had a good idea of what those job numbers were going to look like, although I can't imagine them being anything to write home about. 8.3% unemployment, a lot of hay going to be made over that. Of course, then everybody talks about the underlying numbers. I think that there's more going on in those. I don't know if anybody truly, I think they've been fudged with so much. I don't know if anybody actually still even knows what the real numbers are. It seems rather kind of messed up for me. So we'll continue to do that. And let's see, what else do we have? Oh, it is August 3rd. Every year is the National Watermelon Day. It's a celebration of those great fruits that nearly everyone loves. Kind of a great fruit. Unfortunately, it's had a racial overtone. I think if I was a watermelon, I'd say, let my seeds go. I'm enjoyed by all people, races, and creeds. And don't make me the football of the, I guess it's a fruit. Is it a fruit or a vegetable? So like tomatoes, everybody wants to argue whether or not it's a fruit or a vegetable. I don't know about watermelons. I haven't had people ever bring that up. I just know that it's a wonderful and delicious and wet treat on a hot summer's day. Nothing like finding one of those nice watermelons. Nothing worse than a bad watermelon, though. You know, kind of just the texture's wrong. But boy, get one that's nice and crisp like an apple with lots of juice in it. And, of course, there's no end to the fun you can have spinning those seeds around, especially if you're out on a picnic. Well, this says it's a fruit, so I guess I'm going to... Oh, seedless. Heretic. Stone him. Stone him. Somebody in the den says we should go for the seedless ones. Oh, boy. There's not enough stones around when people go for the seedless. Anyway, I'm sure that's not how God intended the watermelon to be. Anyway, Algo's gone wild. When we look at night trading, a lot of rumors about them being bought out or getting money back. Going to be tough to figure out exactly how that goes, but it was up 25 or 30% earlier today. I did want to point out one note, and that is that on Monday, the night trading had 11.2% of all shares traded. That was 1.4% yesterday. So, I guess the biggest problem with the stock market is people are more than willing to throw you an anchor when you're drowning. Night probably will continue somewhat along the path of getting some money. I think it's a decent enough business, but they probably pretty much shot everything in the foot yesterday or the day before yesterday. It doesn't look like there'll be an ongoing concern without a lot of money, and the question is just how much will they have to give up to remain in business. My guess is that they will be bought out by somebody else. Looks like that $440 million number is actually working out. Behind the scenes, if you really want to know what caused it, no, it wasn't the problem. Actually, the actual problem wasn't a virus on the machine. From the reports I've read, and some of them are pretty good, Charlie Gasparino from Fox Business News actually had a fairly decent article on it. I checked it out, and his sources on a couple other sources seem to match up. They had a $5 billion buy program set up, but that $5 billion buy program for stocks was both a buy and a sell program, and it was scheduled to go over the next 4 weeks. It basically ran all $5 billion in about 15 minutes. It was supposed to be spaced out. One of the last changes they did was to test it, and what they didn't do is go back and reset that this was supposed to be a program that ran over 5 weeks instead of 5 minutes. So it was tested. The test was, though, to be done fairly instantaneously, and what they failed to do was turn it back into real time and know that the program should run and work out its buys and sells over the next 4 weeks. So actually, there's probably, I would say there wasn't a bug, there was an implementation error, and that was to flip the switch back to real mode instead of accelerated time mode. And pretty much that's what happened. Kind of reminds me of the fireworks display, I think it was in San Diego, that all went off in 15 seconds. Almost the exact same thing. It was supposed to be 30 minutes. Everything fired at once, and that's exactly what happened according to the reports and insiders at Night Trading. They just didn't flip the switch back when it was time to open the market in the morning to say, do this over 5 weeks instead of over the next 15 minutes. Everything went real time, and that was that. Company was gone. Poof. Anyway, kind of an interesting problem, but after everybody's been talking about a bug for a while, apparently it wasn't a bug. It was just implementation error and not switching it back into real-time mode opposed to accelerated time mode tested over 4 weeks of trading. At the bottom of the hour, we're going to have Sam L. Savage. That still seems like an adventure novel to me. Probably have a more professor-like name to sell the flaw of averages. Pretty good book. Been going through it. Got a lot of questions for us. He's got the 7 deadly sins of averages, and actually they've gone to like about 11. Oh, our peanut gallery in there says that he thinks it sounds more like a wrestler's name. I don't know. Savage, of course. Well, we'll have to ask him what he thought he was going to be when he was young. But we'll be talking to him at the bottom of the hour about averages and how they can fool us. But everybody needs, especially traders, needs to understand statistics. We'll be catching up with him on that. So what else do we have going on in the market today? Of course, the big pop. Everybody's saying it's on numbers. To me, the action reads very much like a very short market and maybe over short, and people are more than willing to take a little bit of a bite out of the short side of it. I've got several shorts on them, and they're not doing all that poorly. maybe 1%. 1.5% moves out of these. Added actually one yesterday and one today. They're well within their stops. This is a market that could have a fairly decent pullback at any time. The problem is one called self-ordered criticality in the industry. It's actually called the sand pile effect. Eventually, there's going to be one grain of sand, and you're going to have a nice little avalanche caused by that one grain. Also called chaos theory. That is where small inputs cause huge changes, and we'll eventually get to that at some point. But generally, the clue is light volume, and we've got 2.3 billion shares. Looks like we're going to come in at about 2.2 billion shares for the day. Not a bad Friday, but if you're talking about 20 or 30 points in an index, you'd probably like to see a lot more if you were on the long side. But again, a lot of this is everybody shorts, they pop the market, they cover, they re-short, and generally these markets finally crack when there are no more shorts in the marketplace. But very low volume, very narrow trading ranges, pretty good indication if you get all the pop in the morning and then almost nothing, that it is the longs waiting for the shorts to blink, or the shorts waiting for the longs to blink before the end of the day. I'm just thinking that I always want to be on the long side of the market, not long in the being long or short, but where the most movement could be. So could we pop another 20 points? Yeah. I suspect we could go down to 110 points, though, in a matter of days. So we'll see whether or not this continues going on. Somebody says AIG's halted. We'll have to see what that's about maybe during the break. Anyway, I wanted to get to my charts here, and hopefully I can. I didn't have them up yet. So we'll take a look at a couple of stocks just as we go to break. If we've got about a minute here, hopefully we can get a quick look at a couple of them and see how they've done. A couple of these stocks, I think Ryland was one of the ones I was interested in. We've seen a lot of these home builders take off, and I wanted to see how they are reacting now that they've come back down. Of course, these have been, the ones that everybody's been on fire about. Today, looks like it's pulling back into the breakout level. One of the things I didn't like about Ryland Group, symbol is RYL, is no real decent breakout. That is, no sign of strength, no volume as it broke out from the previous levels. Two levels at $23.70, $23.50 on May 29th. And, we continue to get ready, but there was just nothing when it busted above that. We're coming back down in those levels. Volume is lighter, so we might find some support. We'll be back in just a minute.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, David White, Larry Pesavento, Victor Jones, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
This segment is brought to you by Goldfields. For more information, just click the Goldfields banner on the front page of TFNN.com.
And as we come back, I wanted to look at Qualcomm also today. Qualcomm, another one that's kind of bucking up against resistance. Last time we've been up in this price area, you had a $58.75 high on May 29th with 20 million shares. Tried to get above that with 14 million shares on June 13th. We're up on it today. Let's see what I've got, about a little over 7 million shares so far today. You know, we are a little higher than those highs, but I haven't really seen any kind of sign of strength. We want to be very cautious on stocks like this that aren't showing a lot of volume. But we got a few of them out here that look like they are setting up. Google's another one that looks like it's coming into its highs. When we look at it, last major high on May 17th, 637.85 cents, 3.3 million shares coming into that with about 1 million shares lighter right now, but we'll have to see how that actually ends the day, but we're not. But, you know, you probably could get back up to 652, and then there's a 658 high, so there are a couple more just above it. I was asked probably, 4 weeks ago by Steve Rhodes which company I thought I would be most interested in the long term here, and I said Google, just because it's been in a long consolidation for so long that if it broke out, I think it has a lot of room to run. But you can see that wider wider consolidation pattern that we're having. Probably, what is it? Well, let me go back 4 years and take a look at this thing. But it's a massive trading range. Yeah, massive trading range down to from about 433 up to this level. What we've had is, some decent volume up in these highs. The January 4th high of this year, 670.25. But if it could break out of this would be another one, kind of like Microsoft when we've seen it go sideways for 10 years, building up steam to go higher. A nice breakout. Same thing with Intel. We've seen a lot of these stocks build its range, go a little higher, and, look pretty good. In fact, I wanted to look at Microsoft here in this FT and see how it's doing today. Let me see, go back to 6 months. Well, we've had that nice breakout. I think we're in more of a consolidation range. It looks like every time it comes back into that mid-28 level or high 28s, there are more than enough people to try snapping this up. But looking pretty good. Each one of these moves up here looks like a little less energy on the bounce, and eventually all the energy kind of be probably be worn out. We are finding out that, of course, that October 26th is the ship date for Windows 8, their Surface tablet, and, of course, they're going to have the Xbox 720 coming out, unknown on the exact ship date so far. Their new Metro interfaces for all their Windows 8 products, and I guess they're going to have to call it something new. In the news, I noticed that they're dropping it. Must be some kind of trademark issue with it. They're going to have to come up with some kind of new interface name for all the ways of sliding and moving and picking things with your fingers off of tablet style or glass style interfaces. But looks pretty good. Looks like a nice setup. Balmer is saying somewhere between 350 and 500 million copies of Windows 8 will be sold over the next 18 months once it starts shipping. To give you an idea, they make as much money shipping a Windows 8 license, which costs them about $2 now that all the money's already been paid for to develop the software. It's pretty much like pretty much make the same kind of amount of money that Apple makes it selling a iPhone, which is twice as much as money that they make selling the iPad. So software is still one of the great businesses out there, and this is probably going to be part of it. Of course, Xbox 720, new Kinetic product, and some other things they're going to get into. Going to be a big fight this fall for the living room between Google, Microsoft, Apple, and we'll have to see how it plays out. I suspect, though, we're going to see Microsoft somewhere around $37, probably around Christmas. I think the interface is very good. They did go to release to manufacturing for the operating system. That means that they can go make as many copies as they need. Any changes will come as an update. So we'll have to see all that shakes out. Still looks fairly good for Microsoft. Intel coming over the next, I would say, 12, 18 months. So got to be fairly decent for these guys. Next stop, probably when this thing starts popping out, is up to that 33 level. But we'll watch it in the general market. Be back in a minute.
Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to TFNN.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and the Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
And as we come back for the last half of the show here, we're going to have a guest. His name is Sam Savage. He's written the book, The Flaw of Averages. And he gets into, especially us as traders, want to know about averages, statistics. The Flaw of Averages, Sam is best known for his creative exposition of difficult subjects and making it available to the common man. But we need to know how to assess risk in the face of uncertainty. And I guess the old saying that there's lies, damn lies, and statistics. Need to know a little bit about math and averages. Welcome to the show, Sam. Are we there?
Yes, hello.
Okay, good. Good. Glad to have you with us. Tell us a little bit about the Flaw of Averages and why you wrote it.
Sure. I discovered over the years that even people who've had statistics courses don't really understand much about dealing with uncertainty. And a classic case of the flaw of averages, you probably even heard yourself, about the statistician who drowns in the river that's on average 3 feet deep. You know, I heard that in my statistics class. But it affects a bunch of things in finance, in business, of all sorts. There are really two forms of the flaw of averages. The first form you can understand in terms of, say, you know, robbing a bank at gunpoint and asking for $1 billion. It's Suppose you have one chance in 1,000 of getting away with it. Well, then, on average, you make $1 million. And that really is the average. But that's a very poor characterization of a bank robbery to say, oh, I'm going to go off and make $1 million, when you really mean pulling out a gun and asking for $1 billion. That's what I call the weak form of the flaw of averages. And that's the case in which you really ignore diversification. So the only way to get that $1 million on average is if you diversify over millions and millions of bank robberies. Now, the strong form of the flaw of averages is worse. Well, worse than robbing a bank? Well, mathematically it is. With the strong form of the flaw of averages, you don't even get the average right. So the way to think about the strong form of the flaw of averages is consider a drunk wandering back and forth on a busy highway. Suppose his average position is the center line. Then the state of the drunk at his average position is alive, but on average, he's dead. So that's the strong form. And it is based on something called Jensen's inequality, which has been understood for over 100 years, but a lot of my students at Stanford here don't get it.
Well, we probably wouldn't have a stock market if everybody knew all the statistics. We've got to have enough people in the marketplace that trade for various reasons other than that. But I guess the product of the things that I see, especially in the stock market, are people that believe the markets only go up when actually, when you research it, stocks that vastly outperform the market do so for only about 3 years and then actually return to the mean.
Yeah, that would be expected, I suppose. There's one way, sort of cynical way to view traders is, if you have enough people in a room flipping coins, if you've got 1,000 people flipping coins, it's pretty likely you'll have someone flip 10 heads in a row. And now, that person, if they're smart, will never flip another coin in their life, but what they're going to do is write a book about flipping coins. As if their skill in flipping coins is what got them the 10 heads, whereas it was just by chance that 1 in 1,000 did that. So, I think there are some people like Warren Buffett who are out there, really out-flipping the coins, really out-flipping the odds. And there are a few such people. And, but typically those people have got, when Warren says he's going to buy company XYZ, he means buy the whole company. And so I don't think he's working in the same markets as like a small trader.
And I guess one of the other things is that not everything's always the same. Where 9 out of 10 companies, they buy the company and the CEO and all the executives leave, he's one of the guys that actually keeps the people that got them to where they were, for the most part. So there are differences in that, but in style, but for the most part, very few people have come in to match his records, is what you're saying. He's an outlier.
Well, but more than an outlier, he's playing a different game than the rest of us. If I go out and trade on things that I think are going to go up and down, it's pretty much a crapshoot. If Warren Buffett says, hey, I'm going to put these 3 companies together to make a new company, he's actually doing work there, and he's got the power to work at these large scales where he can change the economics of the situation. So I think you have to. I don't think you can put him in the same category as a trader, and I wasn't meaning to. I'm just saying there's some people who are very successful investors, but they've got something else going for them than just trying to guess which way the stock market moves each day.
You've got something that you call the 7 deadly sins, and there's more than 7, but you call them the 7 deadly sins of averages. I guess probably the most obnoxious one that I find is the family with 2.4 children. Right, or one and a half children. I've done a fair amount of consulting to banks and so on, and banks may want to look at their average customer. Well, their average customer may be someone who doesn't exist. In other words, they have a bunch of customers at the low end, students, for example, paying back student loans. Then they have a bunch of rich people at the other end.
And there may be no one with the average assets of the bank, you know? People keeping a few $1,000s in, people keeping some millions in, and yet there's no one with like 100,000. And if you try to manage your business according to the average customer, you're going to have some strange results. Well, think about it in healthcare. You know, imagine the anatomy of the average person who's half male and half female. That's a little weird. You can't design your healthcare program around that person.
What are some of the others? And I've got a small list of your deadly sins here. You've got 11 of them. What have you added to the list?
You know, I can't recall right now what the 12th one is. The 11th one is currently thinking that there are only
11.
11. But listen, here are two that are quite common, and here's one that has to do with the strong form of the flaw of averages. The strong form of the flaw of averages shows up in options. So presumably your listeners know what an out-of-the-money call option is.
They do.
And they probably know that it's worth some money. But if you explain this to a naive person, and you say, well, IBM is selling for $100 today, and I'm going to give you the right to buy a share of IBM in 3 months for $110, the naive person may say, well, look, on average, IBM is going to be worth $100 in 3 months. Therefore, on average, the option is worthless. And that is a classic case of the flaw of averages. And, of course, option traders know that's not true. The Black-Scholes equation knows that's not true. But the man on the street, given similar situations, will simply fall for that. For example, if instead of expressing it as a stock option, I explain to people that they can purchase a natural gas project in which the price of gas, is say currently $100 a unit, and the cost of pumping the gas out is $100 a unit. But they get to pump this thing out like 3 months in the future, and the gas price is uncertain. It doesn't occur to them that this is really a call option on the gas, and therefore this property has great value, even though if you look at the average price of gas, you'd say it's worthless. I've performed this over and over using real money with real auctions to see how people value a gas property with uncertain gas price, and it is exactly a call option, and people don't recognize it out of context.
I guess one of the other things that you do bring up in your book is Monte Carlo simulations. You want to talk a little bit about that?
Yes. Monte Carlo simulation was developed during the Manhattan Project, and I'll bet a lot of your audience knows what it is, but I want to explain it sort of to people who don't know. What it does is it simulates the uncertainty of a market or of a of prices, of demand for a product, or so on. And the analogy is this: what's the last thing you do before you climb on a ladder to paint your house? You shake the ladder. Well, shaking a ladder is in fact really doing a Monte Carlo simulation on the ladder. That is, you bombard it with random forces to find out how stable it is. Now, the random forces you're bombarding it with is known as a distribution in statistics. A bunch of random things coming out. And there are people who say Monte Carlo simulation is only as good as the distribution going into it. And I say that's wrong, because the distribution of forces when you shake a ladder is very different from the distribution of forces when you climb on a ladder. But I don't think too many of your listeners are going to stop shaking ladders now that I've told them they've been using the wrong distribution for all these years. So, in many situations, just shaking the ladder is a way to find out how stable your portfolio is. And there's plenty of statistical data out there to do it with, and lots of tools, lots of Monte Carlo tools now out on the market.
When we talk about some other things in statistics, which I guess really when we talk about averages, we're just one step away from statistics. One of the other things, I don't know if it's in your list here, that I try to bring up occasionally is a lot of times correlation is not causality. But we see so many times in the news that people attribute a movement, let's say in a stock, for news. But there's no real alternate reality. How does that work into your averages?
Yes. So in my book, I refer to words like correlation as red words. The formal definition of a red word is something that cannot be uttered in a singles bar. And so there are a lot of words that people toss around without fully understanding them. And they're very important concepts for which we do need words. But, and as you say, correlation and causality are greatly confused. And a wonderful example of that is the following. That early on, when people were going after the tobacco companies because they were saying, hey, smoking causes cancer, right? At one point, the tobacco companies were arguing, no, I mean, how do you know that cancer doesn't cause smoking? Well, what would the argument for that be? Well, you'd look around and you'd say, people who are prone to getting lung cancer have got this itch in their lungs that can only be satisfied by inhaling nicotine. I think the numbers speak for themselves on that. And you know, it's absolutely right. You really can't show just through statistics whether cancer causes smoking or smoking causes cancer. It was biochemists or biophysicists or something who finally proved what the chemical reaction was that proved the causality. So I think we are programmed, you know, from our evolutionary past to try to associate causality with correlation, and it's a dangerous thing to do.
When we talk about some other concepts that in averages, another one is conditional expectations. I mean, yeah. the idea that the classic one is that you know, if you're a female and you live to 72, you're more likely to live to 85. But if you find a woman that's 140 years old, you can probably bet she's 140 years old in about 5 seconds, right? I mean, it does. I guess averages really don't tell us after time what our expectations are conditionally, right? Yes.
Well, I mean, so this is what I argue. I argue that we really shouldn't use averages, that we should really use full distributions. And I think the way we should really do this is, there's not only one way to solve these problems, but a method that I advocate is actually storing distributions as in databases that store a bunch of Monte Carlo trials. At probabilitymanagement.org, we've got a write-up of this stuff.
We're going to be going to a break. We're going to be back in just a few minutes. We'll give that link when we come back. We have Sam Savage, and he's written The Flaw of Averages. We'll be back in just a second.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pezzavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Time is the great equalizer of all mankind. Time doesn't care about winners or losers, who succeeds or fails. Time only cares that you played the game. Question: are you playing the money game? Is your money working as hard for you as you are for it? I'm Steve Rhodes, author of Mastering Probability, a daily trading and investment newsletter service, and we're celebrating our 1-year anniversary. In year 1, we generated a 30% profit. Plus, I provided 26 hours of live coaching to my clients. My daily newsletter service is available by 8 a.m. each day and covers the stock, futures, currency, and commodity markets, along with all the current patterns that you can trade. Each newsletter is packed with education, and it's yours for as little as $3 per day. And for the next 30 days, you can try it risk-free. Click on my name, Steve Rhodes, on the homepage of TFNN.com and begin your journey to great wealth today. If you're waiting for a better tomorrow, remember this: today's tomorrow will soon be yesterday, and your clock is ticking. Mastering Probability. Now is your time.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
As we come back, we're talking with Sam Savage. He's written The Flaw of Averages. We're going to wrap up the last few minutes here. You were talking about probabilitymanagement.org when we left.
Right. This is an organization that I founded a few years ago with colleagues from Cambridge University and other firms. Dr. Harry Markowitz is on our board now, and the fellow who came up with modern portfolio theory, and Michael Salama from Walt Disney, chief tax counsel there. And we're trying to promote a more rational view of using probability by storing probability distributions in databases. Now, this whole approach is in its infancy, but I've used it at Royal Dutch Shell to help them look at their portfolios of petroleum exploration sites, used it at a big pharmaceutical company. There definitely is movement afoot with new high-speed simulation software coming from a number of vendors and new ways to compress data. We're really trying to push forward a revolutionary new approach to modeling probability.
So is this kind of the equivalent of, in cryptography, actually figuring out what everything would be if it was encrypted already, and then just like lookup tables?
Yes, so a lookup table is a very good way to think about this, I guess. Imagine that we're talking about the the price of IBM in 3 months. So instead of giving me a single average price, give me 10,000 prices, and I'm actually not going, I will use all 10,000. Every time I talk about IBM, in that future time period, I will run all 10,000 numbers through my model, so I'll get a complete distribution of outcomes. Therefore, if I have a call option, when I run the 10,000 numbers through the call option is basically an if statement that says, hey, if I'm above the strike, give me the payoff, otherwise zero. When I run the 10,000 numbers through that if statement, then I get the average value of that call option. So it's reducing everything to, in effect, Monte Carlo trials, modeling the world.
When we let me find something I have here. When we're talking about your book, I guess we've got about 2 minutes here left. What would you think that somebody reading your book would really get out of it when they're done?
Well, it's interesting. I can go to Amazon and see what people who read it on Kindle think is the most important lesson. And the most important lesson is that plans based on average assumptions are wrong on average. And in fact, the law of averages explains why everything is behind schedule, beyond budget, and below projection.
I guess that would be the kind of flaw. No, what do you call it? You've actually got a name for that, right?
Well, that is the flaw of averages. There are several subcomponents. Much of it is based on this thing called Jensen's inequality. Let me leave you with kind of a graphic example here.
Okay, we've got about 15 seconds here.
Well, we won't get to it then.
I figured we wouldn't here, but I guess most of the people look at it as a good introduction to averages and statistics, and probably would that be a good description?
Well, it's to discourage them from using averages and to start using statistics.
Fantastic. I appreciate it. You can get his book on Amazon.com, The Flaw of Averages. Thank you very much, Sam.
Hey, thank you. It's been a pleasure.
You bet. We'll see you on Monday.